FreightWaves today. Julie really had a fantastic day yesterday at the AI Summit in Chicago. By the way, I would argue that the old post office in Chicago was one of the most beautiful places we've ever hosted an event. Absolutely, the Art Deco, just an amazing place.
Yeah, I love Chicago and the architecture.
Yeah,
the architecture boat tour there is one of my favorite things. And yes, the building was great, the venue was great, the content was great, the attendance was great. It was literally full, added chairs. It was great.
We planned on 200 people. We had 260 that were able to get in the room. But I think that was just a demonstration of the topic, the attendance, and the location. Like, Chicago is an amazing place to host a freight event. And look, the old post office, that's freight.
It's cool.
Like, it was on theme. Did you see all the postcards on the wall when you walked upstairs? Did you see that? Check that out.
I don't know, I was kind of I don't feel like I got to enjoy the space as much as I would have liked to as an attendee versus as a, yeah. But one of my favorite parts was also just the conversations that were had outside the room too. I feel like every time I walked out to grab a snack or a water or use the restroom, there were so many great conversations being had around the refreshment area, lots of really good networking, lots of interesting topics. So yeah, it was a great event.
Yeah, I think so. We want to thank everybody for there. We do have the videos on demand if you've missed them. Great conversation around AI. I think the takeaway from that is that AI is not only real, it's happening. A lot of companies are leading that innovation in freight and logistics. It is sort of ground central for a lot of this innovation in AI and real applications. It was exciting to see, and we're going to do it again next year. So if you missed it this year, you can get the on-demand. We also have F3 coming up in October in Chattanooga, where I'm sure there'll be a continuation of AI conversations. We'll continue there. You can get your tickets today. That's the next major FreightWaves event that we have. So in Chattanooga, October.
It'll be here before you know it. Summer's flying by, and it will be fall in a minute.
We're in July. We're almost into August. Kids are almost back at school. I was thinking about the fact that kids were more than halfway through the summer vacation.
I go back on August 6th. Like, we literally had to have a conversation like, okay, summer's flown by, let's make a bucket list. What haven't we done this summer that we make sure, like, we need to have dinner at the pool one night. We want to go to a baseball game. Like, there are things that
August 6th.
Yeah.
Didn't it used to be Labor Day?
I don't know. I mean, I was in Wisconsin for that age school, and it was like we had like a little bit after Memorial Day or near Memorial Day through Labor Day. They have more breaks now, I think, than we did too.
They do have like interim school breaks, but they go back earlier than I remember. I think where I was in school was the week before Labor Day, or Labor Day was sort of the school, but now they go back a lot earlier. My wife is very happy about that, by the way. Like, she sends them to camp because that's the worst week of the year is when our kids don't go. There's like a week before the local schools go back early, I think a week or 2 weeks before, and there's like this dead period where nothing's open. My wife hates it. She's like, put the kids back.
I will miss the flexibility and the slow mornings for them, but the routine will be great for us. We have a great show today. We have Eddie Zukowski, director at PMCF Investment. He's going to talk about M&A and transportation logistics. We also have Spencer Tenney, the president and CEO of the Tenney Group, to talk about that. We're going to talk a lot about earnings. We're going to talk all about money today.
Hunt's earnings. We had JB Hunt earnings, blew it out of the water. We're going to get into that later here shortly. Also, Prologis also incredibly bullish. We'll talk about Prologis' earnings that were this morning. Let's get right to the headlines.
We kick things off with a powerful momentum shift toward the rails that's creating massive growth opportunities for the nation's largest intermodal player. J.B. Hunt Transport Services just reported a record second quarter for intermodal volumes, with loads jumping 10% year over year and significantly outpacing the 8% growth across all U.S. Class I railroads. The Lowell, Arkansas-based logistics giant saw Eastern intermodal volumes surge 16% year over year, driven by what management called conversion activity at levels we have not seen in more than a decade. Intermodal is currently 30% cheaper than truckload, according to market data, and the company is seeing heightened shipper interest for safe, secure, and reliable capacity following the Supreme Court's ruling widening broker liability exposure and a steady exodus of non-compliant drivers from the trucking sector. Revenue hit $3.5 billion for the quarter, crushing the $3.26 billion consensus estimate, while earnings per share of $1.91 came in 60 cents higher year over year. Over in the courts, truck manufacturer Navistar has just won a high-stakes legal battle over delayed deliveries during the pandemic-era supply crunch. A Michigan federal jury on Monday sided with the engine and truck manufacturer, rejecting a $16.5 million lawsuit brought by GLS Lease Co. and Central Transport over the delivery of 1,100 international tractors ordered in 2022. The 10-person jury found that the plaintiffs failed to prove their breach of contract and fraud claims, concluding Navistar was not liable for damages and awarding the companies nothing. GLS and Central Transport had alleged that Navistar delivered only 18 new tractors by the end of May 2022, with deliveries stretching into September 2023, causing the value of their 2018 tractors to plunge more than 75% and resulting in approximately $15.7 million in lost resale value, plus over $1 million in additional maintenance costs. Navistar successfully argued that the 2022 letter agreement established production slots rather than guaranteed delivery dates, and that industry-wide supply chain disruptions, including shortages of Bendix Fusion collision mitigation components, impacted the timeline. Finally, a major Midwest carrier is putting Tesla's long-awaited electric semi to the test in real-world dedicated operations. De Pere, Wisconsin-based Paper Transport Inc., announced a partnership with Tesla on Monday to evaluate the Tesla Semi long range and dedicated operations within the Chicago market. The company, which has logged over 87 million miles using compressed and renewable natural gas over its 15-year commitment to sustainable transportation, is assessing the battery electric truck in an operating environment where predictable routes and consistent mileage provide ideal conditions for evaluation. Paper Transport CEO Tyler Ellison said the partnership expands the carrier's sustainability portfolio alongside renewable natural gas and intermodal, giving customers more ways to reduce Scope 3 emissions without compromising service or economics. The pilot connects to Tesla's broader production plans, with CEO Elon Musk stating during the company's Q1 earnings call that the Semi would begin volume production this year, ramping slowly at first before accelerating later in the year and into 2027. We kick things off with a powerful momentum shift toward the rails.
So Julie, really, when we think about J.B. Hunt's earnings, blew it out of the water. I think there's a couple of interesting things. We're going to get to intermodal, which is really the champion. I mean, it's all about intermodal was really, and I've got a sort of a thought on the fact that I think this is, J.B. Hunt has sort of set the standard for everybody else, set the bar. The bar may be too high for a lot of the other carriers because they don't have the benefits of intermodal. Let's talk a little bit about the brokerage
intermodal
business.
Deals that they have, right?
I want to talk about what didn't do well real quick for a second, because the brokerage business was basically break even. It's been difficult. I think this explains it. J.B. Hunt, as a large asset carrier, you worked at a large asset carrier, tends to have more contracted business than spot. They're buying on the spot market, but they have a lot of their relationships are contract. And you can see this right here, 268 a mile is the contract rate, 355 is spot. That's what they're having to buy capacity at. That's what they're selling it at. That's why brokerage, someone said, why do they even bother? They bother because it enables them to be a single source provider for all the other relationships. Dedicated, intermodal, last mile, that's really what it's all about.
And it does allow them to take advantage a little bit of some of the spot too, with any available capacity that they have.
Yep.
And then also to play that and then hopefully sell it, right? They're hopefully playing that margin gap with all of the data that they have within their brokerage.
But I think in the brokerage business, a lot of it is explained right here, just how the spot market blew. Let's talk about what they did well. So that's sort of like what wasn't amazing. But let's talk about some stuff that was amazing. Let's get to intermodal, because this is all about, let's pull up the 4 chart, because I think this is really what makes this absolutely amazing is just how well J.B. Hunt did.
Yep. Let's see if we have it.
So, let's just break this down. So intermodal revenue, when you look at the profitability, 91.4, 93.3. Really, when we look at the change, 22% increase in revenue. I mean, what are your thoughts in terms of just how much more profitable their intermodal business is?
I think it's amazing. And I think that what's interesting is that intermodal rates haven't gone up that much, right? That's not why there's been a spread.
Can we pull up
it's
the
that
intermodal
volumes
rates?
have gone up, which has driven that revenue, right? And in truckload, you would think, okay, revenue's gone up even if loads haven't gone up because rates are rising. For intermodal, rates really haven't risen that much.
No,
but market share has risen because truckload rates have risen so much that more has converted to intermodal.
That's right. So intermodal rates have not risen. Let's pull up the intermodal spread, because I think this tells us a lot about how much more volume is going through intermodal. Just how dynamic the intermodal business is, right?
Yeah. Let's see, the IMCSI.
So I don't know that we have that. So Julie, when we think about...
The spread is 31% now.
It's 31%. It's
twice
absolutely
what
insane.
It was a year ago.
Exactly. I mean, it's absolutely insane just how well J.B. Hunt performed, and it is the intermodal. One thing that we've heard is that some of their competitors are significantly raising intermodal rates. J.B. Hunt has actually not done that. They gained a lot of market share, but they blew it out of the water. I mean, absolutely, completely destroyed this earnings.
Yeah, it's a great time to be in the intermodal market, certainly as they're picking up market share, and to be J.B. Hunt with the relationships they have with the railroads and the scale and the volumes that they have there. Yeah,
I think they benefited substantially just from the fuel. If you look at the spread between the price, and this quarter certainly did it. The other thing we talked about is once you move freight through intermodal, you benefit significantly. Like shippers start to discover how great intermodal is. They tend to keep it. It's really something that I think is important, and we'll see that obviously in future quarters.
Yeah, and I think that they keep it because once you put in the work to either adjust your routing guide or to adjust, the length of service, the days, right? If you can add that day to delivery, you've already done the hard work to do that. You see the benefits of it. There's no reason to go back as long as there aren't service disruptions, and the rails have been
They've been performing. Yeah. I mean, there is the idea of transcontinental. One of the other things that I took from this was that the East Coast, their eastern seaboard operations, or the eastern intermodal, was the big gainer. Yeah. So domestic intermodal volumes up substantially this year. That's what's driving it. It's not the coastal stuff. It's not the transcontinental. It's
not, although I did read this morning that third best month for the Port of LA as far as number of TEUs. So hopefully we'll continue to see strength there, but you're right, it was all the eastern half that drove a lot of their intermodal.
Yeah, for sure. Well, fantastic. Congratulations to the J.B. Hunt team. We're going to get into this later.
Yeah.
We have JP Hampstead, formerly of FreightWaves, now is at Westbrow Capital, to actually break it down. What was his observations?
We'll be right back.
Stay with us.
It's National Safety Month, which makes this a great time to ask how your fleet can prevent more accidents. Samsara AI detects risks in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara Complete AI Safety Solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/freightwaves.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
All right, welcome back. We are going to be joined by our first guest, Eddie Zukowski, a director at PMCF Investment Banking and author of the Transportation and Logistics M&A Pulse. And we're going to talk the state of the industry and what's happening with mergers and acquisitions. So first, Eddie, can you give us a little bit of an overview of what you do at PMCF?
Yeah, happy to, and great to be here this afternoon. Thank you so much for hosting. Big fan of the show, and yeah, really looking forward to a great conversation with the two of you. But yeah, as mentioned, I'm a director with PMCF. We are a middle market investment bank. So we work with buy and sell side transactions, typically with family and founder-owned businesses, and I lead the transportation and logistics practice for the firm.
So Eddie, what is the state of M&A right now in freight?
Yeah, look, it's one right now where it seems like every conversation we have is filled with excitement, to be honest with you. You know, M&A in the sector has definitely slowed following some of the record volumes that we saw in 2021 and 2022, but we are very bullish on the next, 12 to 18 months plus or more. And we're really hearing that same sentiment, both from, business owners that we're speaking with and large corporate strategics in the space as well.
And what is most active? Is it non-asset or assets starting to come back? Where are you guys seeing the activity?
Yeah, it's a great question. And, I think it's typically top of mind for clients of ours is, do we want to own assets? Do we not? Interestingly, where we've really seen people be most successful is mixed or hybrid. And I'd say a few things about that. One, customers oftentimes appreciate having a dedicated fleet. But also, when you don't own your entire fleet, you don't get caught in the cycle of needing to replace 20, 25, 30% of your fleet in any given year. And that's where we've seen companies run into problems. And so when you're able to have the benefits of owning some of your fleet, but also have some owner operators, lease assets, and or using third-party shippers, to move your product on your customer's behalf, we've really found that to be a sweet spot that, buyers and investors have a liking to.
What do you think is driving all of the activity? Do you think it's the current strong freight market? Or what do you think, what are the drivers right now of this strong M&A activity?
Yeah, I think, candidly, it's something that we think is to come. And there's really three kind of main factors that we've been assessing as we think about that. The first one would point to is just the general macroeconomic landscape and the stability that we're seeing there. It's really more stability than we've seen in quite some time. And that comes from, interest rate environment, tariff announcements subsiding, and there being a lot more clarity in regards to that, and hopefully this global conflict stabilizing. M&A markets always react well when there's broader macro stability. Specific to TNL, you hit the nail on the head, and really the key point is the recovery that we've seen in rates, along with some capacity leaving the market, and what that's done for improving business performance. And then the last thing I'll say is, there continues to be a log jam of M&A activity on the come. And what we mean by that is private equity funds are sitting on record capital to deploy over $2 trillion in middle market businesses. And then a lot of sellers, understanding that the market has slowed, have been waiting on the sidelines until some of the profitability and or buyer appetite to do deals has been growing. And so that kind of log jam we do expect to be opening up as the market is pointing to more favorable M&A activity.
And who's actually buying transportation and logistics companies right now? You mentioned private equity, but is there more going on in the market than that?
Absolutely. The main buyers that we're seeing in the market today are still largely and predominantly strategic acquirers. And, in a lot of ways, it's no surprise. There's a lot of different benefits that can come for strategic acquirers and using inorganic growth, whether they're looking to expand geography, bring in new capabilities, expand their customer logo set, you name it. There's a lot of different reasons why strategic acquirers kind of dominate the TNL sector and really make up close to 90% of the typical activity we'll see in any quarter. The other piece, certainly private equity is there, and we're hearing rumblings and seeing more funds who have an interest in making investments into the TNL space. But currently strategics are the dominant, player.
Eddie, what is valuations doing? Like, where are you seeing valuations? What's the range of valuations in terms of multiples? How are you seeing the market right now?
Yeah, valuation, always the magic question, right? Wide range, certainly. And we can see things, for certain asset-heavy trucking companies, in the more 3, 4, 5 times. We'll see certain asset like tech forward or even software companies trading for 20 times plus or revenue multiples. So there's a very wide range in regards to the multiples and valuations that we're seeing in the space. I'd say a few themes in regards to, what typically pushes people into higher valuation multiples and thresholds. The first would be, and we touched on it earlier, what are the capital expenditure requirements of a business? And that really delves into the cash flow that they're able to generate. Businesses that have a significant drain on the cash flow that their business operations generate by needing to kind of refund equipment and or, invest in technology, whatever it may be, that can become, very unappealing, particularly to financial investors who are very mindful of generating cash flow returns. Some other themes that come to mind with businesses that we see trade at premiums, we'll consistently speak with business owners about, what is your competitive moat? What are you doing to make sure that competitors can't replicate what you're doing, take your customers away? And so is that a best in class in technology? Are you a leading operator? Your on-time deliveries are best in class. There aren't any issues with quality or damaged goods as you're making deliveries. It can be specialized capabilities. You're able to, transport hazmat, high and heavy, different types of things that, just somebody who's going to buy a truck can't, come and take your business from you. So sustainability is certainly top of mind in addition to, the cash flow generation.
So Eddie, private equity is getting such a poor track record, particularly buying into asset-based operators. Yeah. Actually, a really, we'll call it good, if not great, track record of buying into non-asset operations. Is there ever a place in this market maybe that private equity should have the opportunity to do well in asset-based trucking, or should they just stay away from it?
Yeah, I think a lot of it is just about the headlines that come out on the asset-heavy side, right? And I think, for better or for worse, what often, news will end up gravitating to is things where, there are maybe more dire situations and, we know this company's been floundering for some time. Private equity comes in opportunistically and is going to make an investment. They may have to, given the dynamics of the situation, have to, get into more of a, let's save what's going on here. We're going to have to cut heads and reduce the fleet and, find ways to get kind of back to a cash flow neutral perspective. And so, again, I think a lot of what's come out is we hear the headlines of businesses that are floundering and private equity has stepped in and had to do some things that traditionally we as business owners don't like to do. And that's what's controlled the headlines. There are still plenty of case studies where private equity has come in with healthier asset-heavy companies and done great things and really run the playbook on the growth side rather than the cost-cutting side that we know private equity can do. And so, I wouldn't say it's necessarily that they need to steer away from asset-heavy opportunities. I think it's just oftentimes what's grabbing the headlines is these, cash flow and or floundering, struggling businesses and private equity coming in and, having to be the bad guy in the room, to get the business back to a cash flow, neutral perspective.
Eddie, what examples do you have of private equity actually having successful investments in asset-based trucking? What's a name that you've respected that has done a good job there?
I'd have to go back to kind of the playbook and take a look at, some specific names there, but, I'm sure we could come up with several.
I can't. I rack my brain of successful private equity buying asset-based trucking companies, at least in the top 30,
Yeah,
I can tell you, I can tell you dozens of examples of companies that have been private equity backed that went under. But tell me it's a headline problem. Where are the counter examples to that?
Yeah, no, Craig, and I think the other maybe misnomer there, and we got into some of the classification earlier, is what's asset heavy, what's mixed, what's asset light. There are so many businesses out there that are in the business of owning assets and may have meaningful fleets, but they're also operating in more of an asset light or mixed nature. They still have some, they're working with third-party carriers, they're working with owner operators, maybe they're leasing their fleet. And so I think, when we're looking to kind of box in what is an asset heavy company where investments are being made, that is really a much broader universe than what you may be picturing it to, or how some people are, initially thinking about it.
Yeah, I mean, I think maybe in some of the specialized freight where, you're hauling windmills or something, I think there maybe have been some cases there. But when you look at the over-the-road truckload market, I rack my brain of where is the private equity successes? And I just don't see it. I mean, like the companies that have exited, the truckload carriers that have exited, have largely been owner-operator, family-owned. The ones that have gone public. I've had this conversation, is I just don't think private equity should be playing around with assets because they don't really have a good track record. I mean, you've seen this where outsiders outside this industry, non-operators, come into a trucking company. If they don't understand the market, they struggle.
I think from the outside, it feels and looks a lot less complicated than it is. And
it's really complicated.
There's so much that you can't see in the numbers or on a spreadsheet when you get into an operation.
And you can't cut costs because you ultimately can't cut the driver. You got to. That's the number one variable cost is the fixed labor.
Right, and then and then the actual assets, right? I mean, it's a very capital intensive asset.
You can't leverage it, unlike real estate, where you can leverage it up and you get 30-year amortization with the truck. Every 3 years, you got to turn it over. And look, we all know.
And depending on the market, it might not be worth, the truck might be worth less than you owe on it.
The asset value plays brutal. And then you get the problem of, as the business is good, you lose drivers because they're competitive. And as the business is bad, you don't have enough freight to keep your drivers moving. It's a brutal business.
So, Eddie, if there are owners out there who are thinking about potentially selling down the road or their exit strategy longer term, what should they be doing to prepare their business?
Yeah, no, happy to chat about that. And Craig, just one last thing. Looking forward to the next time you guys have me on the show, and I'll make sure to come prepared with some specific.
Eddie, it's okay. We're not trying to do gotcha. We're not gotcha journalists. I'm racking my brain I've been following this market for many years, and I'm not trying to take exception to the idea that it's headlines, but if there was a case study of a private equity firm that bought it and exited, I'd love to know about it because we'd love to feature what they did that made that special. And I don't have a lot of examples. None that come to mind.
No, happy to continue that conversation next time, Craig. That sounds like a great plan.
Yeah, we didn't mean to bring you in here to gotcha, but it does.
No, it's a good look. And the last point on that maybe I'll make is don't disagree with the notion that it's uncommon, right? And I think, Julie, you hit the nail on the head. The operational side of it is more challenging, right? And that's where, people are going to need to have some specific expertise. And with some of the things that have happened in the space, candidly, it's also why they've stayed away from that, right? Given, again, that higher risk profile with exactly as you said, Craig, having to potentially replace 25-30% of the fleet, that is where, people get into jams. And if things are softening and then they have that fixed cost of the driver's side. So, for some of those reasons, those are, why they have stayed away. But, certainly we can find some examples where they've done it and made it work and, leaning on operators to help them drive that.
All right, Eddie, you're going to bring you back. We'll make sure that you bring some examples, and we'll talk about what they did that other private equity firms haven't done, because I'm still very curious as to the examples here.
Yeah, that sounds great.
We're going to get right into the J.B. Hunt earnings. Completely obliterated their quarter. We've got JP Hampstead to break it all down for us here shortly.
Thanks, Eddie.
Huge thanks to today's OTR sponsor, again, OTR Solutions. They believe the right partner should know your business, understand your goals, and be there when it really matters. It's no accident that OTR boasts 4.7 stars on Google. They know that excellent customer support is at the center of every relationship. With responsive teams, industry knowledge, and a commitment to long-term growth, OTR gives customers more than service. It gives them a partner designed to help their business succeed. Learn more again with OTR.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Welcome back to FreightWaves Today. We get two major earnings reports, probably the two of the most important companies in our space and certainly our coverage universe. One is Prologis, reported this morning. Prologis, also incredibly bullish, upgraded their forecast for the rest of the year. Warehouse capacity is incredibly tight. John Paul Hampstead, who's with us, he's a former FreightWaves ran editorial, one of our smartest analysts to come from FreightWaves, is now at Westbrow Capital, is an investor in these things. Let's talk Prologis for a second. Let's pull up the warehouse capacity chart because I think it's really just highlights how tight this is.
Yeah, they said they ended the quarter at 95.5% occupancy.
Yeah.
Yeah, I mean, it's really interesting. Well. So I don't know if we have that chart. Let's pull it up if we do.
And I think they mentioned a record in
there it is. So if you look at this in terms of, that's the LMI warehouse capacity continues to just contract. I think warehouse rates continue to go up. What do you think is driving it, JP?
I think that there's been a lot of development, a lot of people moving inventory in. The economy itself is really good. If you look at the retail spending numbers, for example, they came in less than expected at 0.2% growth month over month. But if you remove gas stations, like pretty much all of that was just because of like lower gasoline costs. If you remove gas stations, it was like 0.7% month over month growth. It's up.
And is that like 0.7% doesn't feel like a whole lot?
They were expecting 0.3%.
Yeah.
So basically double sort of what they were expecting. Year over year, we're talking like 6.7%.
Which is actually a huge number.
Yeah.
So we put it on a monthly basis, it doesn't feel like a lot, but when you put it on a year basis, I mean, that's a huge number. And it really changes the narrative away from the idea that, there was concerns last year about a recession, concerns due to Liberation Day tariffs, what that was going to do to the economy. Coming in this year, it felt like there was some question about the state of the economy. It doesn't feel like that's the case at all anymore.
No, I mean, one of the big questions, and I think what everyone was really worried about was just inflation and the prospect of inflation and what that would do to consumer behavior and even like eventually like interest rates and things like that. But it turns out that like inflation, except for gasoline and energy, is like mostly under control.
What is driving that? Why do you think we have really solved the inflationary problem other than energy prices?
That's a good question.
Shippers certainly don't. Shippers certainly don't feel like inflation.
I mean, they're paying fuel. They're paying for fuel.
They're paying for fuel. They're paying higher trucking rates, higher international container rates. I mean, international container spot rates are up to something like 3x from where they were just a couple of months ago.
Right, but the PPI is falling, and so is CPI.
So really, this inflationary concern about as you have higher freight rates is just not showing up in consumer prices.
Yeah, and I must have read the same article you read this morning because I read those same numbers. And what I thought was interesting was not just that spending had gone up a bit, but where it was going up, right, and what was driving that. Obviously, the fuel costs fell, but online sales rose nearly 2%. Some of that fueled by Amazon Prime Day and some things like that. And then I think the World Cup drove some of the sales too, because you saw hobby and sporting goods and all of those things went up.
Drove some of that too?
Maybe.
Yeah.
Freddie's back on X, by the way.
I saw that. Earlier this week.
Now.
So the number that they talk about in the hospitality industry is RevPAR, or like revenue per available room, right? And everyone was like monitoring the World Cup, like host cities, and seeing how it was doing. But and they did very well. But what was surprising to the analysts, and we keep getting emails about it every day, is how RevPAR was up like across the entire U.S., not even in World Cup associated cities, but like people are spending money, people are traveling.
The interesting thing is, when we saw fuel prices go up, there was this panic in March and April that would really sap consumer travel, it would sap consumer consumption. Didn't happen at all. In fact, the airlines have been able to maintain higher prices. Even when we saw fuel prices drop, jet fuel prices drop significantly, a couple of weeks ago, the airlines have did not lower rates to reflect that. And look, you and I have been traveling. I've been through a lot of airports lately. They're very full. In fact, more so than I remember. So the travel season's really, really tight. Tells us a lot about consumer, but I think when we talk about J.B. Hunt's earnings specifically, it's intermodal. The story is really intermodal. And not, if you look at the rest of the business, dedicated was way up, but really this is an intermodal story.
Yeah, it's an intermodal story. I mean, what was it, 10% volume growth, which is a huge number for intermodal.
Revenue for the whole company is up 19% year over year, which is an absolutely just pounded expectation.
EPS up 45% year over year.
That's insane. That is an insane number. Now, this is
It's especially, I think, unusual for J.B. Hunt because most people in capital markets view J.B. Hunt as being really optimized for the late cycle, right? They think that, intermodal pricing really comes in sort of after, contract truckload has already come up, right? And so the fact that they were able to beat so strongly against already very high expectations this early in the cycle, I think is what really sort of impressed people.
I think the other thing is, when you look at intermodal revenue up 22%, the volume of really intermodal across the country, we've talked about domestic intermodal volumes have been significant. We've had both the AAR and IANA CEOs on FreightWaves today just talked about how strong that domestic intermodal market is. One of the interesting things to take away is the fact that this is a shift from the transcontinental to really an eastern side of the United States, an eastern a portion of intermodal, is doing exceptionally well, which I think may have been a surprise for some people, is that shippers are now taking advantage of intermodal in different parts of the country.
Right. The eastern side of the country, Darren Fields was talking about, has shorter lengths of haul. But it's actually sort of better for J.B. Hunt in a way, because they said that Eastern network is much more responsive to truckload pricing, whereas the Transcon is kind of its own thing, and they haven't been able to take as much price on the western half of the country yet. The eastern half, smaller revenue, gross revenue per load, but that number's coming up much faster.
Capacity hasn't been as tight. Truckload capacity hasn't been as tight on the West Coast either as it has been in the Midwest and some of those
Exactly. And if you look at the map, that really, when we look at the overall haul map, it's been the Midwest that has been absolutely crushing it in terms of, you look right here.
Blue.
We talk about the blue markets because that's the important markets. If you look right here at the chart, those blue markets, and this has been this way, I cover this every single day on my Sonar update. The map isn't changing very much. It's really that Ohio Valley, the Rust Belt is where there's incredibly tight capacity conditions. There's obviously industrial activity is improving. That's driving some of it. We've talked about the fact that the center of the country is producing freight. It's really a shift in really the overall capacity map.
The other thing that I think it gives investors a lot of confidence with J.B. Hunt going forward is something that Brad Delco said a little bit later in the Q&A part, when people were kind of talking about, sort of why Hunt did so well in this quarter. And he said, our financial performance has largely been driven by things under our control, with the benefits of what's happening in the market still to come. Basically saying that, we've benefited from higher demand and higher capacity. We're getting tons of opportunities, record number of, new intermodal business and things like that. But we really haven't even started repricing our freight that much.
Well, I think it's important. There was a report, I was talking to one of our analysts, that they were seeing other intermodal operators do significant rate increase. The conversation was a Hub had increased their rates to this one customer by 15%. J.B. Hunt hadn't taken it, which means they're gaining share. And I think it does two things. One is it tells us that they're gaining share by picking off price. It's obviously not hurting their business at all. They're gaining market share, but it also tells us there's a lot of earnings capability in the future. You talked about it being late cycle. As they've gained intermodal volume, as shippers start to really trust that intermodal service, they're likely to retain it.
Right. I agree. And I think your point is spot on, that this is still early in the cycle, and that so we're seeing the initial transition to intermodal, right? And then we'll continue to see, as rates go up, the transition to dedicated. They were up nearly 9% in revenue in dedicated. That's a longer term contract, a longer term cycle, as all of the other truckload markets continue to tighten up. And people are getting a little bit more desperate for capacity and want that security, the safety, the reliability of dedicated. You'll see those rates continue to rise later in the cycle as well.
9% increase in dedicated.
Yeah, 8.7, I think. Yeah.
This is a long-term, these contracts you've mentioned, it can take over a year, many years in some cases, for shippers to decide.
Or they're in 3 to 5 year contracts already with a customer, right? So you might try to take a mid-cycle increase in an unexpected market like now, but they don't come up for bid as often.
I'm talking about shippers deciding, hey, I want to take advantage of dedicated. I really want, when you have tight capacity, dedicated is important because they start to really worry about their supply chain and what that means for them. The other thing is, I think the Montgomery decision means that shippers want to have two things. So they want to have access to capacity with a trusted partner.
Yep.
They don't want to leave themselves up to the spot market. And the other thing is, when you have capacity shortages, you need dependability. You don't want to hire your own drivers because of the liability associated with it.
I would not want to get into a private fleet right now. But if you're a dedicated, this would be a great time to start trying to convert private fleets and take on that liability.
And Hunt kind of said, there are people coming to them for dedicated. They don't want to give in on price. They're committed to, disciplined, profitable growth. They kind of highlighted that, like, look, for us to add trucks and dedicated, it probably costs a lot more now than it did a few years ago. Drivers are harder to find. But I think that as this, and shippers, the minute spot rates pop, they're not going to say, oh, we want to lock in, capacity for 3 years at this price. They're going to have to, get religion about this upcycle and basically take their spanking, and then eventually they'll say, okay, yeah, we really need you guys.
So let's pull up the intermodal savings chart, because I think this is a really interesting, just basically how much money shippers are saving moving freight to intermodal. I mean, if you look at it, we're not at record highs. I mean, the record high was really, if you go back a couple of years when trucking markets there was a significant delta, a lot of COVID-related activity, 34% savings. What's your read on that, Julie?
I mean, yeah, and that's nationally, right? It has to be in specific lanes that you can actually do intermodal in.
But that's more than 44%.
That is more than twice what it was a year ago. So as fuel has gone up and truckload rates have gone up, intermodal rates haven't really gone up yet, and that spread is continuing to widen.
Atlanta to Chicago, 44% savings. It's a major lane. Inside of Sonar, you can break it down.
And that was always a hard one to do profitably on intermodal, because that versus truckload, because it's that shorter length of haul for intermodal. And so that, to me, is incredibly telling.
Why do we think that the railroads have not changed pricing aggressively in terms of contract pricing?
I mean, why haven't they taken intermodal rates up on like?
Let's pull this chart right up, which is really I think it's probably the most interesting chart that tells the story. Is you see the green is that trucking spot rate is absolutely on fire. The red is contract trucking prices. Intermodal has really not moved a whole lot. And I think there's a big advantage of that for someone like J.B. Hunt. Why do you think we aren't seeing substantial movement in intermodal contract?
I think they will. I think it will come up. It has to. I mean, they said on the call that, especially in the East, they think a sustainable discount to truckload is 10 to 15%. Right now, it's double that.
Yeah.
So that pricing is going to snap up.
Who is the beneficiary? Is the railroads or does J.B. Hunt? I mean, J.B. Hunt obviously gains a lot of share. I mean, what are your thoughts, Julie?
I think it's both. I think J.B. Hunt can go up on some of their prices while they're to their customers, their shippers, the beneficial cargo owners, while the railroads move slowly. And I might get hate for this, but
no pun intended. They do move slowly.
Yeah. Oh, yeah. That was a good pun, man.
So good.
But so they move slowly when it comes to rates too. It is going to take them longer to raise them, and frankly, they are a bit dependent on what's happening in the truckload market to be able to do their rates, and I don't think many of them have enough visibility to it to really know. I was always surprised when I worked in pricing with the railroads. I did our intermodal pricing for a long time. At the lack of technology they had.
Well, they do have Sonar. A lot of the railroads have Sonar. They're seeing the activity,
some of them do have Sonar.
Intermodal volume market share is good, and I think it's important when we look at regional mix. The fact that this is happening on the East Coast. In fact, let's pull up domestic intermodal volumes, because I think this tells the story of what we're looking at right now, is just how robust the overall intermodal volume is.
Yep.
I mean, look at this chart. This is absolutely the growth of intermodal, and a lot of that is that East U.S. as trucking capacity gets tighter. To me, that really helps the efficiency of the railroads, because a lot of the traffic historically has been coastal into the center of the country. Now it's the center of the country moving a lot of freight.
Let's explain this chart a little bit, because there's a lot of lines on here, right? So the blue is the total domestic rail container volume loaded across the United States, versus that next line down, the yellow is the outbound rail container volume loaded in 2025.
Yeah, that was last year.
So the blue is current year. 2025 is yellow, coming right under that, and then it goes
and the pink is
backwards,
24.
right? 24 is green, and then 23 is pink.
But the growth of this on a year-over-year basis is absolutely substantial, and you're seeing just the expansion of how much growth we've got.
It's interesting to see what happens going forward. Another one of the things that Hunt called out on the call was really tight drayage capacity. I don't know if like those particular markets have been hit particularly hard by like enforcement or
I understand that's the case. I understand
heard that
the
from some of the other
immigration
guests
story
that drayage capacity
is actually drayage is being significantly impacted by immigration.
One of the
and
analysts
recruiting dray drivers has been hard. Yeah,
one of the analysts asked on the call. They were like, "Well, can we get any more juice out of like drayage, like driver productivity or like turns per day or things like that?" And they're like, he was basically like, no, like we don't think so. They're pretty much going to like all out right now.
I wonder what their turnover number is.
I want to talk a little bit about the idea that this, what does this mean for the broader trucking market? So stay right with us. We've got messages coming up. We're going to get right back into it. We're going to talk about what this means for the broader market and what the read-through is for the overall trucking market. Stay with us.
In freight, again, your customer experience is everything. Every quote, order, and status update is a chance to win or lose a customer, but that will still, again, run on manual disconnected systems. Pallet is the leading enterprise AI built for the supply chain, automating costly operations from code to cash across brokerages, carriers, forwarders, shippers, and warehouses. Mallory Alexander serves 3 times more customers per operator, deliver an exceptional customer experience at scale. Visit them right now at pallet.com.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Welcome back to FreightWaves today. JP, what does this mean for the broader sector?
I think it's pretty much unequivocally positive. I mean, all the other truckload names were up on the news. I think that it might temper expectations, honestly, for companies that don't have a lot of spot exposure, but the ones that do should benefit even more. I mean, if you look at like Knight Swift's sort of consensus expectations, the street expects them to grow revenue by like 40%. So that's what they have to do to like meet expectations, and
that's everyone what the street is already priced into the stock.
That's what like the average of like the analyst models sort of say about Knight-Swift. That's what they expect. And then they know that it has way more spot exposure than a company like J.B. Hunt. So I think, it sort of just depends on where you sit in the market and how soon you're expected to kind of benefit from these. But
I don't know that this tells us, it tells us a lot about market conditions. It tells us a lot about shippers shifting freight. We know that intermodal gets a catalyst out of higher fuel prices because of the spread in fuel. But it also, a lot of the record was something unique to J.B. Hunt.
Yeah.
Like I think if you look at this story and you read the headlines, you're like, wow, this is great for the whole sector. Maybe it's not what we think it is in the sense that it's great for the whole sector. Markets are tight. We all know that. But this feels like a very J.B. Hunt specific story.
Well, I think intermodal carried it, dedicated, I think their mix of what they're offering is versus brokerage.
Brokerage
it would be so hard. It's showing the pressure that brokerages as a whole are under. So
it's going to be interesting to see what the pure play brokerages do, right? If you look at the ICS numbers that J.B. Hunt put out, overall revenue was up 49%. That was a combination of higher volume. I think volume was up 19%. Revenue per load was up 26%. But margins compressed by 300 basis points year over year. They actually improved a little bit sequentially from the first quarter. They caught up, I guess, on some of their contract pricing in ICS. But, they made $1.7 million in operating income on $388 million. And so it's like
the brokerage business, but we talked about this opening show.
And pure plays are managed a little bit differently, right? Like they might, from what I understand, brokerages that are attached to assets sort of, they're definitely involved in putting liquidity into the network and making sure that everything is balanced.
I don't know how they share freight within
For lack of a better term, it's
some of the higher paid freights going on their
in
truck.
certain cycles.
Yeah,
and I think it provides a relief valve for the assets, particularly. But I think, look, my view on this is J.B. Hunt is a very special story. It doesn't tell us a ton about the pure truckload carriers, except markets are tight, rates are way up, they'll do well. But I think J.B. Hunt, certainly, its model is the winner here.
Yeah.
I think what you can say, I think the clear read-through is that truckload tightness is partially responsible for exceptional intermodal volumes.
Absolutely.
For sure.
And so, they're benefiting from that sort of secondary effect.
And higher fuel. And I think regional mix. I think the fact that this is happening in the middle of the country and is not happening relying upon the coast is a very different freight economy than we've seen.
Yeah, I agree.
But I think J.B. Hunt is incredibly well positioned to take advantage of it. Well, JP, thanks for coming in.
Thank you.
It's always good to see you and breaking down the stories. Again, Prologis absolutely increased their forecast. Industrial warehouse space is incredibly tight, and J.B. Hunt just killed it. We'll see what this means for the rest of the sector, but I think I would give J.B. Hunt credit entirely up to the management team and their model. I don't know that it tells us a whole lot about the rest of the sector. Stay with us.
Getting reliable capacity can be complicated. Let RXO make it simple. As the third largest provider of brokered transportation in North America, RXO has the scale, resources, and expertise to help you tackle any shipping challenge. From a last-minute spot load to a managed transportation solution, from LTL to intermodal, from trained logistics experts to AI-powered freight automations, RXO has you covered from the first mile to the last mile. Start shipping on easy mode with RXO and get a smart solution to move your freight. Learn more at rxo.com/capacity.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Welcome back to FreightWaves Today. It's just a busy news day with all of these earnings reports. It's always my favorite time of the month. I mean, my favorite time of the quarter, because you figure out what's happening, the truth in the markets. And we're talking about M&A. We're going to continue the conversation we had earlier. We have Spencer Tenney. He's the president and CEO of the Tenney Group, who works with companies on M&A, doing deal advisory, deal scouting. Spencer, welcome to FreightWaves Today.
Good to be with you guys. Thanks for having me.
All right, so I'm going to open up my conversation. The prior guest that we had, we talked about private equity's track record in asset-based trucking. I would love to get your take. Has there been, outside of specialty, I'm talking this over-the-road market, have there been cases of private equity funds that have been successful buying asset-based trucking companies and then exiting?
You know, I was listening to that, Craig. That was painful.
Is it painful because there isn't a lot of examples, or the prior guest didn't?
There's not a lot of examples, but I can tell you like the ingredients of what could make an example. We did a deal with a company called Texas Transeastern, a fuel hauler out of Houston. This is late last year, platform private equity investment. Why I think this is going to be successful, this is a 9-figure type transaction. They have translatable experience in an asset heavy. They had done a very large roll up in the waste management space prior to that. And I think why I think they're going to be successful is that they have a very good plan. And as a matter of fact, as part of our mid-year report, J.J. Schickel spoke directly about this. Like, what do you need? And Tom Conley did as well from Red Dog Equity. What do you need for a private equity to be successful? You have to have a right fit. And in many cases, the reason why a lot of private equity deals and asset-heavy industries don't fit is because private equity needs someone that wants to run hard. And in many cases, people are exiting the asset-heavy industry because they're out of gas. And so I think part of a lot of the criticism around why private equity doesn't do well, it's well earned. But I think in order to be successful, you have to have someone who has translatable experience, but you also have an owner that's going to roll forward equity that still wants to run hard for probably 3 or 5 years. And once you get that, I think that is, I think that's a good formula for success. There's not a lot of them, as you said, and maybe none of them that we can point to on the fly here. But I do have high hopes for this deal with Two Roads Partners in Texas Transeastern out of Houston.
Well, again, a specialized tanker bulk.
Well, it's you were asking Claude earlier, like,
I did
what
some
are
research
examples?
in the break.
And you had a couple.
But they were all highly specialized bulk or.
Which ones are they, Julie?
They were Keenan Advantage Group. Again, tank trucks, liquid bulk carrier, and Quality Distribution, which was chemical and bulk ISO tanks.
Those are the examples that we've got is, again, specialized freight, bulk, chemical, hazmat, where it's not the commoditized.
Not just
a lot
regular,
of that's, by the way, dedicated.
A regular route, one-way trucking. That's.
There really isn't a spot market much in the chemical sector because it's a tanker sector because it's consistent, it's and so forth. That seems like a much better fit for private equity than the over-the-road for-hire market.
I mean, really, I think the math around a traditional platform investment in truckload, it's just not competitive relative to other industries that private equities can invest in. I think that's the main issue. You know, why the few occurrences of success have been in specialized. I think part of that is because it makes for a good partnership. Private equities come into a specialized environment and know that they don't know everything. So they just resource these already established, highly specialized companies to grow at scale. And I think that's a good partnership. Anything short of that is you know, this is a very unforgiving industry. I know you understand that as a second gen guy, Craig, but I think that's, you gotta be really careful about the partnerships with private equity. When they have the right ingredients, they can be successful, but they're few and far in between.
Spencer, I'm going to correct you. I'm a third generation. My grandfather, Clyde, was actually Gen 1. My dad would be Gen 2. My father has actually said we might be Gen 4 because we had a family farm. And my great-grandfather was hauling produce to the farmer's market. That's the old school trucking. That's where it all got started in the 1930s. So we've been in this industry. We got diesel in our blood here in Chattanooga. Spencer, I got to ask, where is private equity having success? And what are you seeing in deal activity right now?
I mean, deal activity, going back to my interview and our mid-year report with Red Dog Equity and Eve Partners, I asked each of them one word. What would you describe the deal environment right now? JJ says busy. Tom says quality deals. And, you know, it's been a long time since we had those two words paired together in an M&A environment. I think that's kind of where we're at right now. We have, as your prior guests talked about, we have for the first time pretty stable macro elements that is critical to driving M&A activity. But there's also a lot of other things that attract private equity investment. Number one, you know, technology disruption. I think that creates a lot of opportunity. But the other side of it is, yes, we have high rates, but as Jason Cannon reported this morning in CCJ, we also have record cost per mile effects going on in this industry. So when you have that tension, that's where you see the need for consolidation, and then that's where you see private equity seeing opportunity.
My theory on private equity is they oftentimes don't understand the cycle. That's what it comes down to. And they buy at the wrong time because, again, they're looking at historical earnings. And anyone who the Wall Street attracts this market, that's why, you know, Knight-Swift is trading something like 350 times. Their PE multiple is 350. And you look at that and you're like, whoa, this is way out of sync. It's just like the short seller who kept harassing RXO in the fourth quarter of last year because he thought that, you know, the business had some structural issues without understanding the cycle. And you have to understand the cycle. And that's where I think private equity gets in trouble, is it just doesn't, their timing in these things just doesn't work out because they don't understand the cycle. And I think ultimately they have to understand the cycle to really know how to time their entries and exits in these businesses.
Yeah, no disagreement there. I think as your prior guest noted out, about 90% of the deals are with strategic. So like contextually speaking, I think most of the private equities that could invest in this space self-elect out for good reason because it's not a fit. And so this is a very unforgiving space, especially for investors. And I think you have to have very clear line of sight and understanding of the cyclical nature of this industry as part of your investment thesis. Otherwise, not going to go well.
So your report speaks a little bit about some of the investors and they're changing their priorities maybe now than they were 6 months ago. What are those priorities now and how have they changed?
I think number one is just speed. I think there's a recognition that as the last few segments of your show, we're talking about how good the conditions are getting. I think there's a certain level of urgency to try to make a really strong play towards the best companies you can possibly acquire right now, because it looks, at least based on the conditions around us, that they're probably only going to get more expensive to acquire. So I think speed and execution is probably number one. The other side is just, the Montgomery case brings some sensitivities around liability around transactions. So we're seeing some significant shifts in sequencing in the way that folks address diligence around a deal. So I think those are some of the main things.
Spencer, in a post-Montgomery world, how are they actually measuring and pricing that risk in? It seems like it's a massively unknown.
No, it's definitely unknown right now in terms of how that might affect valuation. We haven't gone through a full cycle of insurance renewal, so that's a little bit too early to be determined. But what I can tell you, what I've observed, what I'm hearing from other investors is that, understanding that carrier vetting process earlier in the diligence process as a whole is certainly getting more attention, and they just want to have a look under the hood, understand if there's any other potential liability associated with the existing carrier vetting process. So those are just some features of what's going on right now. But I also think that even as we just saw in the announcement with the C.H. Robinson and Despear, even as market conditions improve, there's still significant trends around focusing on specialized operations and increasing capabilities through proven products. And so the Despear acquisition is a great template for that. And the fact that C.H. Robinson has really not been an active player in the acquisition world ever, I think this just kind of speaks to the fact that we're moving into a space within our industry that whether you've been, had used acquisitions as part of your growth strategy, you're probably going to moving forward. And the most risk-averse place to put that is in a highly specialized operation with a huge moat around it. And that's kind of what we saw in Despear.
Yeah, I mean, look, you could argue that J.B. Hunt is an example of a portfolio of highly specialized businesses. I mean, intermodal, we talked a lot extensively about intermodal. Last mile, that's a specialized business. It's not the commoditized truckload. They have the freight brokerage business, and they have their over-the-road trucking business. Those didn't have exceptionally good reports. Intermodal, banged it. Dedicated, absolutely destroyed it. And last mile did well. That's really a reflection of the portfolio doing well that's highly specialized, going back to what we talked about.
Yeah, and I think it's all like in context. I think that this is a very large company that has specialized units within it, but also benefits from everything that comes from having a very, very large family of companies or divisions within that space. So I think there's a lot of, it's not apples to apples to compare some of these other companies that are called, maybe sub 200 million in total revenue or sub 100 million in total revenue. Very different set of challenges in terms of what's required from them to be competitive in a, ever-changing competitive landscape. So I think I think the focus on highly niche, specialized operators that would take you otherwise 5 to 10 years to kind of replicate what they're doing, that's a great investment as a part of delivering more value to your customer and holding your competition to the side as you're trying to grow your business. I think those are just great moves without requiring folks that may not be as experienced in acquisition to take risks they don't want to take. So that's kind of the take that I would have on that right now.
Spencer, I assume JJ didn't leave us a playbook on how to take an Omni and turn it into Ford Air. Probably one of the most unusual transactions that we've seen, and certainly created some really interesting storylines. Any thoughts on who buys Ford Air?
Not that I want to share publicly, but I've got a few. But I've got a few ideas, Craig. But
I do as well. I think Amazon should buy it. I've said their airport-to-airport business is incredibly interesting. We'll be right back. When we come back, we want to show you this viral video that's playing out. It's these wildfires in Canada. I think it's a really interesting. Just stay with us.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Welcome back to FreightWaves Today. Look, we couldn't wrap the show without talking about a viral video circulating online with a CN Rail train crew trapped inside their locomotive as wildfire surrounded them in Ontario, Canada. These wildfires are absolutely playing havoc on this, but look at this right here. I mean, just I don't know if we have audio, I can't hear it in my ear, but the train crew talking, and basically another train came and rammed it to move them out of harm's way. They did escape safe. They are safe, Zach. This is absolutely an insane video. I mean, luckily the crew is safe. They were able to get out alive, uninjured.
Yeah.
Apparently a truck that they were also in caught fire and they had to escape that.
Oh my God, okay, I didn't know that part. But yeah, no, for those of you that haven't seen wildfires in action, like you remember the California wildfires a few years back.
I do.
The speed with which these fires occur, it's like, how do you get engulfed? How do you get stuck in a wildfire? Well, they're on a train. They go
on
two
a train
directions
down the track,
yeah.
And it just happens so quickly. It's so dry up there.
And I was watching the Weather Channel the other day, and I watched these fires. Actually, they caught them on visible satellite, and I watched them. And we're talking a stretch of thousands of miles, almost igniting all at once.
Well, let's pull up the map, because I think this is also telling just what this means in terms of air quality. And we have this map inside of Sonar. Yeah. What you can see is that gray shaded area is where the air quality is bad. By the way, this is through Weather Optics, our risk management platform inside of Sonar. You can get all sorts of weather, but that gray area is where, and that pink, I don't know if they call that magenta or pink or fuchsia, whatever. Is it fuchsia?
Yeah, fuchsia.
That fuchsia area right in the middle of it, that's actually where our next guest, Ben, is at, is right in the thick of it all, is just how bad the air quality is up there.
Yeah, I think, and I also heard that they are basically expecting Canadian wildfires to be a regular occurrence now, like in the way that the way the climate's setting up.
Yep.
It's just drier up there this time of year, and
well, they also have
natural.
They've eliminated a lot of the forestry, deforestation. The same thing happened in California, where they thought it was better to keep the forest because of this carbon sequestration.
But they made it work.
Problem, but it ends up making these things far more violent because you just have a lot of kindling to do it.
But air quality issues, of course, affect those trucks and the operating, and I think the visibility up there is terrible.
Yeah, the visibility's up there. I'm going to Oshkosh next week. That's the big air show in Wisconsin. A couple of years ago in 2023, it was very hard to sort of enjoy the air show because the smoke, the smell, but also just the soot that's in the air. It's hard to even see some of the aircraft.
And this is unhealthy. Like,
it's very unhealthy.
This level, I mean, I have asthma. You have asthma. So, I mean, this is not something that they're even advising people in the far northern stretches to just like get out of town.
I wonder what it would look like if I had my N95 mask, because I've got to go up to Oshkosh on Monday. Yeah. We host a party. It's the big air show. I might bring the mask. I may get a lot of looks if I do that.
But I don't know.
Look, I think it is interesting in talking about not deforestation, not actually doing this. It does leave you have these incredibly violent storms that are just prime when you don't.
It's a totally natural process. This is not like arson that they found so far. So this is actually part of nature that. This is how these forests operate if you leave them be.
Do you want to know a crazy stat that I read? Is the amount of carbon that comes off of wildfires, is more between Canada and the United States, more than the entire emissions from the industrial sector.
Yeah.
Like that is, it shows that like this whole, this idea that we're supposed to decarbonize
let's not.
Mother Nature is in charge.
We can make a whole show on this.
You certainly could. I mean, Mother Nature's ultimately in charge of all this.
Oh yeah, we have no control. There's actually, back several million years ago, they have this in geologic record that the amount of carbon in the atmosphere has been significantly higher throughout geologic history.
Sure. Well, also volcanoes are the big.
Volcanoes are huge. There were so much there. Anyway, I'm not a geologist.
Well, look, appreciate it, Zach. What do you have today on Freightonomics?
Oh man, so we're going to dabble. I got to dip my toe in the JB Hunt earnings a little bit there. Not going to cover too much of that, but also we've got a maritime situation. The imports still continuing to be a prominent thing. Stuart Charles wrote an impressive article there that we're going to talk about, and then we got Ben Peterson, former transportation procurement manager for General Mills, who now works at Sonar, is going to come on and talk about a couple of his sit reps as well as our PPI.
And sit reps is all about research, long-form research, which is really available to Sonar subscribers. Really everything topics from how do shippers deal with this?
Yeah, he's the shipper perspective here, so he's going to talk about some of the strategies that from his perspective.
Shipper choice is important. That's a hot term that always gets popped up. He's got a sit rep on the shipper choice.
Whenever the market gets tight,
everyone cares about shipper choice. Well, this is before I go, one last question for you. The Prologis read through warehouse capacity, warehouse pricing. They increased their outlook for the year.
Right.
What are your thoughts on sort of what do you think that means for the broader market?
I mean, I think it suggests that they're thinking that they're going to continue to see a lot of this inventory being brought in. They think inventories are going to grow. Even though warehousing costs, talking to Dr. Zach Rogers over the last several years, warehousing costs are not very volatile. You talk about transportation prices going up and down all over the place. Warehousing prices haven't been that volatile, but inventory costs and warehousing prices have been extremely reactive over the last couple of years, and it's been a target for many shippers to try to reduce that. So I think it's fascinating to see. And again, the question is this a pricing increase, revenue gain?
No, this is a capacity.
A volume.
Like if you look at it, it's volume, capacity. Prologis talked about the fact they're getting a lot of new activity. In different parts of the country, by the way, not just the coast. Like a lot of their business has been on the California coast, by the port of LA. A lot of this is center of the country.
Well, it
matches the JB Hunt report.
Reorganization of supply chains that is ongoing. I think there's so much happening here. You've got USMCA who knows what's going to happen with that coming up. So there's so much going on in supply chains right now that I think people are just trying to build out adaptability into their structures as well.
Well, fantastic. Well, we'll be back tomorrow at FreightWaves Today. Stay tuned for Freightonomics right after these messages.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Welcome back to Freightonomics, now a component of the FreightWaves Today segment on Thursday. I'm Zach Strickland, head of Freight Market Intelligence here, and we do have a really good show today. We're going to have special guest Ben Peterson. We're going to bring him out to talk about the shipper perspective. He has written a few sit reps for those Sonar subscribers out there, and Craig, of course, explained them a few minutes ago. Long-form research, but also deep dives into some data and strategies. So Sonar subscribers have access to deeper contextualization, research, forecasting, modeling type capabilities with the data. So we'll get to him here in a bit. But first, I think, we talked about, you've heard us talk about JB Hunt on FreightWaves today. We're going to go through that here in a minute. But I think setting the tone, keeping with tradition, market in two to get things kicked off here, just to give a quick table set on where my head's at in terms of the freight market. So if you guys are ready in the back, we can pull up those charts whenever you guys are prepared, if I want to count myself in or not, or we don't have to do it yet. There we go. All right, so 3, 2, 1. First one's up, S-Try, Sonar Tender Rejection Index. You see this all over FreightWaves today and all over Freightonomics, and it's going to be that way for a while. We came out of the holiday, which traditionally, the call out here is that we see normally like this peak. So we settle down in June, and then rejection rates pop back up around 4th of July. That is not the case. We're kind of we had a plateau in June, and we had more of a rollover around the 4th of July, and things are stabilizing now, and they did drop fairly quickly coming out of the holiday period, but now they look to be flattening out around the 16% threshold. Still very, very high. And I think this is going to be the read moving forward is, what does this trend line, if you were to draw a trend line from that peak value in early June, ignore the holiday noise for a bit and look at that trend line, and it points to still a very tight market throughout the rest of the year, and I think that's exactly what we're going to see. Let's look at the spot rate chart next. NTI. So spot rates, more emotional, a little bit more noisy, and also the relationship between spot rates and the rest of the market has changed dramatically since the Montgomery-Carib ruling. Broker liability, carrier vetting is now increased, so we're going to have a new reset here. This is going to be a totally new threshold. Spot rates and contract rates are going to have a different relationship moving forward. I think we're going to see this baseline increase. However, a lot of emotion in these rates while they're figuring things out. We are starting to see a little bit of a stabilization there at the end of that chart. You see that line turning more to the right there than straight down. So following with tender rejection rates, we're starting to see a little bit of consistency in the day-to-day rates. Let's go to the next chart, STVI demand. We're going to talk to Ben a little bit later about the PPI. It's also going to break some of this down for you, but demand staying on point, staying exactly where it's been. And then the last chart I want to show you, contract versus spot. Both of them still going up, pretty much. I mean, we've got a spot rate coming down after the holiday, but they're still very elevated. Contract rates are up roughly 15% year over year. So this is going to be an ongoing thing. We've got several months of this cycle, I think, at minimum left, pending some sort of weird economic noise or demand side signals. Rates are up, spot rates are way up. And just because they came down in the near term doesn't mean that I think you can take too much of a breath there from a procurement strategy standpoint. So we did have some economic releases here over the last week. This is a big week for economic releases. And soon I may have an economist join us here on the show, hopefully here in the coming weeks. But for now, you got to deal with me reading some of this data. So CPI came out. The reason CPI matters, the reason you care about CPI is because it sets monetary policy moving forward. It has an influence on economic demand. How well is the consumer doing in relation to inflation? Didn't mean to do that rhyme there, but the CPI was 3.5%, down from 4.2 in May. So that's a fairly good signal, but it's still not out of the woods yet. A lot of this, of course, a derivative of energy, some of that gas price coming down. We just heard about it in the retail sales figures. PPI also coming down from last month's highs. And if we hadn't had that reignition of the confrontation in Iran, Strait of Hormuz, still fairly shut down. I think we could take this as we are moving past the peak of inflation. But since that has changed, I think we're still we're not quite out of the woods in terms of having to be concerned about inflation and how it's going to influence monetary policy. If the Fed does choose to take this as hey, we can control it, which if you heard Dr. Zach Rogers on last week's Freightonomics talk about this, that's not necessarily the right thing to do, because if you increase interest rates, the borrowing rate, you're influencing demand side dynamics only. This market is very supply centric. The thing we're talking about in transportation isn't a demand driven cycle turn. It's capacity, supply side that's changing, not you actually want to lower interest rates to encourage investment in that scenario, because if people aren't able to take out a loan to buy a truck or equipment or grow their business, capacity is not going to grow. So I can make the argument that increasing interest rates actually hurts in the long run on this cycle. However, I'll leave that to more of the experts. The last big report this week, removing from inflation here, retail sales. You heard JP Hampstead talk about this a little bit on the FreightWaves today, but up 0.2%. If you remove the influence of gas prices, it's actually up 0.7%. One of the reasons I don't love retail sales figures is because they're not adjusted for inflation. And of course, the headline figures tend to be seasonally adjusted. I hate seasonal adjustments on any figures that you give me at this point, because what is a traditional season since the COVID pandemic? We've really broken a lot of normal seasonality out of the equation. So this, I think the 0.7% increase month over month in retail sales, if you exclude gas, is actually a very positive figure. It means consumers are resilient. Some of the things that did drive this figure, non-store retail, we had Prime Day in June this year versus last year was in July or August, I believe. And so that's going to make the comp year over year a little bit different, a little bit wonky. Again, seasonality changed this year versus last. Prime Day, of course, a big driver of the e-commerce. Sports and hobbies, also up 1.3% month over month. FIFA World Cup has been driving a lot of new sports equipment purchases and things like that. Love FIFA, by the way, and the World Cup. I'm not a big soccer guy, but I have been watching a lot of it, and you can see it reflected in the retail sales, so that's good news there. Autos also surprisingly up 1.9% month over month. And electronics follow with a 0.8% up reading. So there is some positive takeaways here. None of these figures are adjusted for inflation, however, but I think there is still a good sign that consumers still like to spend money. The American consumer cannot be stopped, no matter what, I don't think. But doing a little bit of research this week, we can't necessarily, I don't want to be doom and gloom, but also I want to tamp down some of this, I don't want to be overly exuberant either. You can tell that I have been reading my economics lately. So some of the concerns moving forward from demand side economics. We've got a consumer that has been spending through a period of time where maybe they shouldn't have been spending. The savings rate is still roughly 3%. So that's historically low. That is not where they want it to be. It means that a lot of consumers are spending their savings and not holding it back. That is not what many economists consider sustainable. So there's weakness there. They did start having more discipline on their credit card spending. We did see revolving credit come down over the last month from April to May. but that was also traded off for the non-revolving, I'm sorry, it was revolving credit came down, non-revolving went up. So we saw like the auto loan purchases, that's the type of credit that did increase over the last period of time. So debt levels still not great, not terrible, but there are some risks moving forward in this economy. So that being said, there's a few stories that I want to call out that you guys should check out on FreightWaves.com. Make sure you read the latest TL, LTL rates to hit new highs in Q3. This is TD Cowen, AFS Freight Index report that Todd Maiden writes. Definitely something worth checking out. Gives a little bit further context. If you're a Sonar subscriber, if you watch Freightonomics, FreightWaves Today, you already know most of this stuff, but I think it's helpful to have that additional perspective. The report said that more than 48,000 non-compliant drivers have been forced out of the industry year over year. That is, for context, that is a huge number. There's millions of drivers supposedly available, but 48,000 is not a small figure, and I think it may be understated even in this context. So definitely check that out. The next article, which is probably, if you read nothing else on FreightWaves.com, read this one. Stuart Charles, no, it's not this one. This is the Port of Long Beach record. This is sort of a byproduct of the next article I want to call out. But Port of Long Beach, third highest June on record. And then you have the next article, which is going to interview Dr. Noel Hasegawa. I hope I got that name right. I'm sorry, this is the turbulence. This is the exact article I wanted to talk about. Traditional peak shipping season, no longer a thing. And this is the new CEO of the ports out there, talking about how year-round waves of cargo have replaced this traditional peak season that would normally for imports happen around August, late July, early August, and into September. That's no longer the case. It looks like, and again, you can blame some erratic trade policy. You can discount these as one-offs. But the reality is that we really haven't had a normal seasonal summer peak season as was defined as before COVID in a long time before COVID. Like I said, if we pull up the IOTI, so this is the inbound ocean TEUs index. This year, you can see it's not necessarily a peak, sort of mirroring what I was talking about with the truckload space, more of a plateauing. And this is a moderating trend. Once they, increased their ordering practices in early June after the announcement of the tariffs, they really didn't exceed last year. Last year is in yellow there. 2025 ordering volumes hitting all-time highs. This was higher than COVID, by the way, if I were to pull this up in a lot of situations. And it was that reaction to the cost prohibitive tariffs on China. So once those got removed, everyone had to catch up and then also pull forward simultaneously because we still didn't have any clarity around what the tariffs were going to be moving forward. So we can talk about record volumes in June. I think that chart also really points to a strong July and probably into August, because this is a 14-day moving average on the IOTI. It also is representative of bookings of containers that haven't yet left the ports across the ocean. So you've got a minimum of about 15 to 16 days before it hits the ports here. So that means we've got, 14 days left, 15 days left in the month of July. About the time that ends, we still have a lot of volume coming in. So anybody operating around the ports, drayage operators, JB Hunt Intermodal, I don't know if you guys heard, they blew the doors off. JB Hunt, of course, is more domestic intermodal volumes. Imports tend to influence the international sector first before getting transloaded into the domestic side. So JB Hunt, I'm still looking for a bullish outlook on JB Hunt. If we look at JB Hunt's earnings, of course, Todd Maiden covers this. On FreightWaves.com, some of my key takeaways that maybe Craig and JP and Julie didn't cover on their show. I think the fact that their truckload sector really, it went negative in terms of OR. It was actually over 100 OR. Purchase transportation, looks like they were caught a little bit off guard here. If you look at their equipment for the truckload sector, it's down almost 400 units year over year. And this is normal. I'm not really saying this is kind of a negative. It's just, this is typical of a carrier that has now been caught off guard with their book of business has grown because the shipping community has now outpaced what their available capacity is, and they had to purchase a lot of that transportation. They'll recover, they'll get this back, but it might be having some sort of interplay with ICS and brokerage, which margins are contracting year over year, not necessarily month over month. It looks like they're trying to right-size some of their contracts here. All positive things. Domestic intermodal, though, I mean, the reason these guys take some of these negative hits is because they are so broad and well diversified within the space. I mean, you heard Craig and company talk about this on the show before, but when you have domestic intermodal, you have dedicated, you have truckload, you have brokerage, all of these things sometimes don't move in tandem with one another. Something that helps intermodal sometimes hurts trucking and vice versa. So we really have to take this with a grain of salt when you see some of these ups and downs. Overall, they're winning heavily. The domestic intermodal volumes, you saw the chart, huge. One of the charts, yeah, go ahead and bring up domestic intermodal. Like, it took me a long time to figure out, like, to actually see this chart for what it is. For those of you that don't look at loaded domestic container volumes, which I'm sure a lot of you don't, this chart, it looks a lot like the truckload chart in years past, like the COVID era chart. Domestic intermodal volume swings do not happen on this scale. This is a 13% year-over-year increase in June that you're looking at. That is very, very uncommon. So the volume growth in intermodal cannot be ignored here. The question is, can it grow further? Can they handle more? The peak season for domestic intermodal, like I said, is actually later in the year, around September, October. You can see it reflected on the chart. It kind of rises as the year ends. Does this volume get higher? And I think that also brings into the question, does service, it's already getting a little bit slower, as reported by Stewart in the article. Does it still have that infrastructure resilience? The drayage community is exposed to this heavily. So that's what I wanted to cover there on the first part of this segment. I think we need to take a quick commercial break. And after the commercial break, we're going to bring Ben Peterson on to talk about that shipper perspective. Stay tuned and we'll be right back.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Welcome back, everybody, to Freightonomics. I'm Zach Strickland, and I'm bringing on a guy that, rarely in my experience in our industry do we get a chance to talk to the other side of the perspective. Ben, of course, used to be, now works at Sonar, thankfully. He used to be the manager of transportation procurement at General Mills. So he's seen everything from the lens of a shipper, and I want to welcome him to the show to make his FreightWaves debut on TV, helping me out today, bringing on a guest, but also he has got a plethora of knowledge, and I love the perspective here, Ben. You have written a couple of pieces. You're now taking over the PPI. For those of you that have been following FreightWaves and Sonar for a while, the PPI is one of our most popular data points that's actually not had the formulaic approach to it as much as you have just provided here, and you found a way to do it and apply it historically too. So Ben, first of all, welcome to the show. Give us a quick introduction to your background, and then we'll get into the PPI.
Yeah, absolutely. Thanks for having me on. Excited to be here. Like you said, it's my Freightonomics debut. So joined Sonar. I've been with the company for about a year now. Prior to that, I spent nearly 10 years on the shipper side. Most recently managed the transportation procurement team at General Mills. And then prior to that, I managed middle mile transportation procurement for Target. So I have a lot of experience on the shipper side of things. And then before that, I spent time at a 3PL as well. So I've been in the transportation industry in one form or another for about 16, 17 years. But yeah, and that's why I joined Sonar. I think have some unique perspective, and I get to work with a lot of our potential and current shipper customers to really help our data make sense to them internally, to really take their data and mesh it up with ours and drive efficient and effective transportation decisions.
And we are glad to have it here. So Ben, without further ado, I pulled up a chart of the PPI that you actually produced in your piece here. Talk about the PPI and what it's actually doing, and then I want to get in a little bit to the methodology and some of the data points that it's getting into. So give us an introduction here.
Yeah, absolutely. So the PPI is our pricing power index. Essentially what it's doing is giving a high level overview to understand where the pricing power sits between carriers and shippers. And it's on a scale of 0 to 100, with 50 being more of a neutral environment. The higher that number goes, the more it leans towards the carrier's favor, and the lower that number goes, the more it leans towards the shippers. As we've seen over the last few years here, it's been in the shipper's favor. Pricing's been very aggressive. There's been adequate capacity, but towards the back end of 2025 and obviously into 2026, things have shifted. Naturally, before that was more of our market experts looking at our market indicators and our data and then making a qualitative assessment of what that number is. So I took a little bit of a different approach, and me being a very analytical thinker, wanted to view if we could, simplify that a little bit or make it a little bit more quantitative. And so I took some of our major market data sets, a lot of the ones that you had talked on with our tender volumes, our rejection index, and then a lot of our pricing components, and really put them on a scale. Yep, as shown here. And what that does is it looks at the 5-year history of each individual metric, and then it puts that within a percentile rank for that. And so what that does is basically it makes that all consistent. So those are measured in different ways, right? So volume or percentage for rejections or in dollar values. Right. What that allows it to do is then be able to score on a same type of scale. And so from that, it totals, and it's using a weighted methodology to ultimately generate what the PPI is. We have back tested it. I did a good amount of back testing, and it generally tracks, right? And so after a lot of trial and error, the methodology seemed to be pretty firm.
Yeah, I like that you're into math like me. I want to pull up that box one more time here, because it also, I didn't have a way to really validate this signal cleanly until I saw this inside of your explanation. But we talk about this market being very supply centric. I just went on a rant about it just a few minutes ago. But this box, if you look at this, so you're looking at a lot of different indicators. For those of you that don't know Sonar, I'm just going to make it simple for you. There's a couple of demand side indicators: rail, IOTI, ASTVI. All demand side, they're volumes. So basically, when you see a high percentage, that means we're in a very elevated demand side state. If you look at these volume indicators, IOTI is up there, but I just showed you that that's not necessarily, it's a little bit of seasonality. ASTVI, accepted tender volumes is in the 20th percentile. This is super low. I mean, and again, it's not a total picture because we're ignoring the rejected tenders. So ASTV is probably the low estimate of demand right now. But that being said, STVI is also not necessarily super high in the terms of overall percentage. But when we talk about this being a primarily supply-centric environment, that's really an indicator that really sticks out to me. And S-Tri being at an 84, NTI being at a 96.9 percentile. Spot rates are in the 97th percentile of the last 5 years, and that includes COVID, mind you. That's insane to me. So kudos to you for pulling this together. I think it's definitely, and of course it's available in the Market Monitor for those of you that subscribe to that. It's also, is it still available on the vlog, Ben? Or
I'd have to check. I can't. I think I know it's in Market Monitor, and I'm not sure if it's in the blog or not.
But anyway, great reading. And what's the current reading? Was it around 70?
I think it jumped from 70. Last week's was 70, the debut of it. And a lot of that was influenced by holiday volume, obviously with the 4th of July. And it rebounded pretty heavily this past week up to 79. And so, yeah, the capacity didn't downsize, right? Demand shot up. I think one thing that's interesting to look at too, when you talk about ASTVI in particular, and I was looking at this morning as we were talking about some of our daily watch stuff, is ASTVI is the lowest it's been in comparison to the last 3 years, but STVI is the highest it's been in comparison to the last 3 years. And that just reiterates the rejections, right? And that's going to give some additional understanding there. But when you look at ASTVI, that's actual execution, right? That's volume that is being accepted by the carriers and actually moving throughout the network. And I think that's a really important indicator as you start to measure what's moving throughout the country.
Yeah, I agree. It is a pretty solid. I like looking at ASTVI and STVI together because ASTVI in a tight market basically tells you where's the threshold. How much can carriers handle? When rejection rates are above 10%, that means that carriers don't like to turn down existing customers to haul other freight generally because they know they have to buy that customer back somewhere down the line. And so it's an interesting component because I'm not seeing ASTVI really grow over the last bit. And that would be the indication that capacity is actually becoming more available, growing, more consistent, whatever you want to call it. And we're really not seeing that cyclical signal around how it's going to turn in the near term. Rejection rates are going down, but it's largely because we're seeing the seasonal kind of flow of demand fall off a little bit too coming out of June. But the next piece here, of course, sit reps for the Sonar subscribers. You're well aware of these. You just wrote one. It's not out yet, but you wrote a shipper of choice one that was preceding that. And I think that there's a little bit of overlap here, but this one that you just wrote, I want to tease everyone and be sure to look out for it if you are a Sonar subscriber. If not, check out FreightWaves.com, which we generally cover these high level on FreightWaves.com. If you want to get in the weeds, you got to subscribe. The sit rep that you wrote here is basically explaining how shippers need to view, you call it optionality. I call it flexibility. I call it adaptability. It's really an article or a deep dive into some of the strategies that shippers can employ to help them. I talk about J.B. Hunt having a hedged portfolio of business. Shippers can hedge their transportation networks to markets like this, and it calls out obviously the sonar signals and a lot of the sonar data that you can employ in some of the strategy around it. So it's a little bit of a use case there, but talk about this sit rep and why you wrote it.
Yeah, I mean, it was influenced. I joined a panel last Thursday, and the focus of the discussion was around managing risk and building contingency plans. And so that really sparked my interest in expanding on that from a shipper point of view. And I think often as we get into, the markets that are shipper favorable, a lot of things are built on efficiency. And so they optimize costs and don't consider some of the alternatives. And when that market flips, some of those are exposed rather quickly. And on the shipper side, cost is a major component, obviously, but you also focus on capacity and you focus on consistency. And those things start to go out the window if you don't have plans as the market tightens. And so this latest sit rep focuses on the optionality and how you need to evaluate that and build it into your network. It focuses on things of carrier optionality. What does your tender waterfall look like? When when your primary rejects, what is your strategy for going to secondary or tertiary carriers, and not just having any in place, but having a foolproof plan that will actually allow those carriers to execute your freight if needed. It talks about the spot market, and for some shippers, they're very hesitant to enter a spot market tool into their network, just given the perception of what that means. But there's really strategic ways to do it. And in any given market, a spot market tool can prove beneficial. And so thinking through that strategically, I think ultimately with a lot of the sit reps, the intent is to really start critical thinking, especially now. So as the market has shifted for shippers, it needs to begin thinking out. They need to think outside of the box, because the typical ways that you saved costs last 2 or 3 years is not going to be sufficient right now. And so that includes things like mode conversion, looking at your truckload lanes and saying, hey, is there an opportunity to shift these to intermodal? Obviously, we've talked about J.B. Hunt's doing very well. Some shippers are taking advantage of that. But also there's more unique styles of mode conversion. Could I break down some of my truckloads that aren't actual full truckloads and ship them LTL? Taking freight off of the spot market and moving it contract if it ships consistently enough, or vice versa. And so just really evaluating all avenues you can go down to potentially capture some of that cost savings in a different manner than you've been able to the last couple of years.
Yeah, I like the way that you made it approachable too, because a lot of the strategies that you talk about, in my experience, some of the companies out there don't really have a lot of background or experience in exploring multiple types of strategies, such as, I love the one box that you call the backup carrier myth. And that made me chuckle a little bit. But I love the concept there. It's like, just because you have a carrier sitting there that accepted something from a year ago, and now they're number 2, like what makes you think that they're going to be ready to go when you come knocking a year later when the market flips? I think that's a fantastic call out there, because it's like, we all do this in every job that we get to. We just kind of start taking certain things for granted. And I think when the transportation markets are working, shippers, just like any business, they start just thinking that it's always going to be there. And I think these are great ways to think about how you need to consider, you don't have to pick all of these strategies in once. And of course, the data, of course, helps you make it a little bit more informed, so you don't just have to go in dry and then not know exactly what you're doing. Which particular, you worked in the shipping community during COVID. Which of these strategies do you think is probably the most easily levered in an environment like that?
That's a good question. Yeah, I was with a retailer during COVID, and obviously we all remember the toilet paper crisis. So that was a fun experience. I think when I think about the contingency plans, it's the tender waterfall is the most actionable, but it's strategically thinking about how you implement that tender waterfall. And I think your call out on the backup carrier box was one that I put in intentionally, because there's a right way to do it and there's a wrong way to do it, right? To go forward and just put in a rate that a carrier provided in a bid 6 months ago, and you don't tender them any of that freight for 6 months and then expect all of a sudden they're going to handle a load that falls through, is unrealistic, right? But if you think through it and say, hey, I have other carriers that are operating in this building. They're not a primary on this lane, but they are a primary on other lanes. Maybe they'll have available capacity to support in the event that they need to. Or strategically think how you give your secondary carriers the advantage to be able to support additional freight if and when needed. So I think it's just thinking through those in a different manner. Everyone knows what a tender waterfall looks like or the general concept of it, but how do you take a strategic approach to make sure if and when those levers are needed, that they actually are operational and an effective solution versus just a plan that you have in place?
Yeah, it's funny too, because you deal with this, and I think you dealt with this internally at times, in your previous life, where, you don't get your door knocked on until something breaks. And in the meantime, it's like, well, I was trying to build out these strategies to help avoid these problems, but I wasn't given the opportunity because nobody's thinking about it. Well, now I think this is a way for you to say, hey, look, for those of you out there that were like me, here's the roadmap. Here's the way that you can present this. And I think data always helps. There's no CFO on the planet that doesn't respond to data. No good CFO, I should say. And the way that you can kind of say, hey, here's some strategies and here's where it makes sense. Here's the ROIs on having an appropriate strategy moving forward. And then, of course, it bleeds into this shipper of choice sit rep too that you just wrote. Give us a quick high-level overview. And of course, I'm being told pricing power index and the Sonar sit reps are only available inside the market monitor or inside the research in the bottom portion of the SOAR UI. So call us up if you want some of this, but tell us about the shipper of choice.
Yeah, this is obviously it becomes more of a buzzword in the type of environment we're in, where when things get tough, everyone wants to look to understand what does it take to become a shipper of choice, right? And it's way outside of just the rate components. It's a really big scope of what are the different parts of your network that a carrier really evaluates. How do they view your cost to serve, and how is your relationship with your transportation providers? And so it looks at things as your facility efficiency. How quickly do you get your drivers loaded and unloaded? How does that program work? Do you make the drivers sit at a dock and waste time for multiple hours? And how does that affect the way that they view wanting to manage your freight? And payment strategy is another key one. I wrote a separate sit rep just basically on payment terms too, because that's a key indicator into how you get priority with your transportation providers as well. How quickly do you pay them for the services they provide you? Your freight consistency, that's always one that I focus on, load leveling, volume consistency, how consistently week over week do you ship on your lanes? And so multiple components outside of just the rate side of things. My biggest proponent being on the shipper side was always the partnership aspect of it in any given environment. So you have to have your strategic partners and understand that shippers have their priorities, carriers have their own priorities, and you need to be transparent about what those are to meet an end goal, right? And to work together to say, hey, we have our cost structure, you have your own, savings goals. How do we make sure that those mesh to ultimately make the best decisions for both of us?
And wonderful perspective there, Ben. Thank you so much for coming out on Freightonomics. You're definitely going to be coming back, so might as well. You crushed it today, and thanks to everybody that's viewed today. Be sure to stay tuned tomorrow at noon for more FreightWaves Today.
Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
The map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home.
Welcome to the new Coast to Coast North American network. Driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit, streaming live June 17th. Register for free at live.freightwaves.com. Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
Six years ago, Jerry Murphy was a felon and an alcoholic who already drank one business down. Today, he owns two trucking companies. One of them has been hauling for over 40 years. And the man who built it and every other buyer at the table came to it, went to Jerry because he trusted him with his people. But the part of the story nobody knows is what happened in between the handshake and the signature. In those months, the deal sat in limbo. Jerry lost his brother, and a man 6 years sober found out that rock bottom has a basement. He never picked up a bottle. He picked up a phone instead. This is the most honest conversation I think I've ever had on this show. Call it rock bottom to rock star. So let's get into it.
If you run your business on guesswork, you're putting yourself in a bad position before the wheels even turn. And right now, more than ever, who you align your business with matters. One thing I've always been a big fan of is transparency, whether it's knowing your numbers, knowing your lanes, and knowing exactly what you're getting into before you even book a load. And that's why Amazon Relay stands out. Upfront rates, unlimited mileage, accurate mileage, and real appointment times, these are the things you can actually make a decision based on facts and not just assumptions. Whether you have box trucks, drive vans, it doesn't matter. What matters is you're operating with clarity and consistency. So if you're serious about building something sustainable and not just chasing whatever pops up, make sure you go to relay.amazon.com and check it out.
Welcome to The Long Haul, the podcast dedicated to empowering small carriers and owner-operators to drive their business forward. I'm your host, Adam Wingfield, bringing you insights from industry leaders, real-world success stories, and strategies to help you navigate the road to profitability. Whether you're just getting started or looking to take your fleet to the next level, this is a show where trucking meets opportunity. So buckle up, it's time to go the distance.
Welcome back to The Long Haul, and I've known today's guest for almost 2 years. We talk every couple of weeks, and I can tell you there's no version of him for the cameras. What you're about to hear is the same man I get on those calls. A mechanic out of Circleville, Ohio, who was pulling a semi at 14 and learned how to drive on the twin-stick R models. He built Murphco Logistics from nothing, and this summer, he bought a trucking company that's been on the road for 4 decades. Getting here cost him more than people would have paid, and that's the conversation.